Great, let's get going. This is Euro, and I think this is probably quite a good place to start. Largely because we've had some important moves out of Euro today. We've also had some very key. We've had some very key data out of Europe and out of Germany in particular, which has really kind of changed the outlook. Now, great, let's get going. So we had some key economic data out of Europe, and it is important because it's very important, largely because Germany is the biggest economy in the Eurozone, and they've started to sound a little bit dovish. So what I mean by that is that they've started to Germany, the Bundesbank has softened potentially to the idea of more monetary easing. One thing that we know that has helped Euro through the bad times, of weak economic data, the Cyprus crisis and the Italian election impasse, if you like, has been the fact that the ECB hasn't followed the Bank of Japan, hasn't followed the Federal Reserve into these huge stimulus programs. So basically, the yield differential, though it's not great, it certainly helps support the downside in Euro. Hence why, since July last year, we've gone from the low being kind of, near to 120, then we got kind of 126.70, and then last time we got just below 128. So the last dip back in March, we got to 128. So basically, we've got a series on a much longer term scale. So those people who trade multi-month, which I know is not a lot of you guys, but it's worth just looking at it from the medium term. Euro is still in an uptrend. However, this decline here between the 50-day moving average and it's now testing the 21-day exponential moving average. This level here, this green line here, a luminous green line, which comes in at 129.40, is the 200-day moving average. So it's just a simple moving average. The red one is the exponential. Well, we've already gone through here, but the simple is actually very popular now. So you've got to, like with kind of everything in the Euro, in technical analysis, it's all about kind of where the crowd is, and the crowd is now that we've gone through 130. We're currently testing around about 129.80. If we get below there, a massive level is 129.40 because it's this green line, because it's the 200-day simple moving average. A lot of people look at it. It means that it's going to be significant. And what does that mean from a trading perspective? Well, it means a couple of things. Number one, when you get to these really important levels in the market can do kind of, I guess three things. It can either shoot through it on the downside and maybe open the way then to those sub 128 levels that we saw last month. It can hover around it for a while, so it can cause a little bit of range trading as the market just takes a breather, maybe book some profits if they've been on the short side, trading Euro lower below that kind of double top at 132. Or it can kind of bounce from there, so it can bounce higher. So people use that as a bit of a buying opportunity. Now, the reason why we've had this sharp decline, look at that for a daily candlestick here, in Euro dollar has actually been because the sands have shifted a little bit. So the fundamental picture has changed, and it's become more euro negative over the last 24 hours because we had more weak German economic data, and now it's adding to pressure that the ECB will potentially cut interest rates or loosen monetary policy in some way. By cutting interest rates, they've got two interest rates that they kind of target there. One is an interest rate for banks, and one is an interest rate that kind of affects, say, you and I, the average person in the street. And they could adjust that. So where will we go from here? Well, we do tend to think, and I put out something on our website earlier. It could actually be up on FX Street actually now. We tend to look at, or what we tend to have done is, or what we're looking at is the potential that, well, yes, the PMI data is weak. Yes, we may test this 129.40 level, but we don't think by itself that is enough to push us any lower. So we think that will act as support. The market will potentially stabilise in the short term around that 129.40 level. But there is more economic data, and remember, next week we do get the ECB meeting, which is quite important, which is going to be an important one. So that's all going to be kind of out there. We just because it rests at 129.40 doesn't mean it will go lower, but just to manage your expectations, I know a lot of you are kind of shorter term traders. You know, we could go lower, but it may take a while, basically. So it could be a good resting spot. Could be where we see a little bit of kind of a bounce back in euro in the short term. So again, if we were to get down to 129.40, I wouldn't be surprised if we were to bounce back maybe to that 129.80 level, maybe even 130.10, but we think that will then cause more selling pressure. And the reason why, there's a couple of reasons why. Number one, this double top here at just above 132, look at it. Tweezer top suggests that, you know, we've put in a medium term top now around about 132. That is where the sellers are coming in. And the fact that we've got through some major resistance levels suggests that there's, you know, we're not going to get back up to this level. Major support levels suggest we're not going to get back up to this level because this area here, kind of between 131 and 130.50, now is a massive resistance zone. So that's just something to watch. You know, this is a daily chart. Let's take a look just on a shorter time frame, 30 minutes, just to see, you know, that's been a very sharp move. We are just stabilizing a little bit around about that 129.80 level, as I mentioned. But again, we think that could just be a resting zone before we test that 129.40. We do think we will probably get there in the next, or there's a chance that we will get to that 129.40. So test that 200-day moving average in the near term. Now, below the 200-day moving average, that's a serious bearish development for that cross, and we think we may not convincingly break through it until we get some more information about what the ECB will do next week. So remember, we could be volatile the closer that we get to 129.40. I've had a few good mornings from Gregorian and Anise. Good morning to you both. Thank you so much for joining. We really do appreciate it. Now, the other thing I want to show you, because again, we've got these kind of weaker currencies, or currencies that have been kind of, the euros, if you think about, say, the G10 FX space since the beginning of the year, the euro's actually been around about the middle of it in terms of performance against the dollar out of the G10 currencies. Gregorian's asking me if I'm going to look at gold. I will. Just bear with me one moment, Gregorian. The euro's kind of been in the middle of it, and now it looks like it's weakening. Now, the pound has actually been at the weakest end. So what we're seeing now is the pound is continuing really to, let's go just quickly back to the daily chart so I show you what it's done. The pound has been, like, you know, one of the weakest performers, or the second weakest performer in the G10, along with the yen. It obviously found very good support below 149 and has bounced higher. However, again, look at that, another nice double top there at 154. Now, why is that level important? I'm going to show you now. Just bear with me. Because it's the 38.2% retracement of the down move that we saw from January to March this year. So it's important, it's significant. You've got to look at it. That is a significant resistance level. It counts, it matters. Sellers came in at that level. Now, where are we? I don't think I'm going to take off that retracement chart because if you can see here, again, we've fallen through a major level. We've already fallen through the 21-day moving average. That's negative. Just bear with me one moment. We are, 152 now becomes a massive level. 152 is the 50-day moving average on the close. So that's not actually on this chart. I do apologize for that. But it's on this one. So this is a Bloomberg chart. Don't be too intimidated by it. It's just got a black background. Bloomberg is pretty old school like that. Jeffrey, hi for joining. You've said we're pricing expectations of what Carney is going to do. Well, yeah, I mean, we priced his expectations from kind of December to March, right? In that down move. Then we just thought, oh, hang on a minute, it's not going to do more QE. But yes, I think the expectation is that there will be some more QE, potentially even before Carney takes the reins. Remember, Carney doesn't come in until the 1st of July. There's another 2 Bank of England meetings and an inflation report. And remember, what does the May MPC meeting mean? The May MPC meeting comes when comes on the same month as an inflation report, where the Bank of England in the past have liked to change policy around about an inflation report. So while we think potentially that the MPC at the Bank of England is getting more dovish, and we heard that from one of the members who didn't vote for more QE. They also at the April meeting, they sounded very dovish in the meeting last week. Now Jeffrey brings up a really good point about the pound, that we could be pricing in some weakness. Now we did get weaker public sector data, finance data today, which has hurt. So basically we're borrowing more than we said we would. It weakens kind of the government's austerity debate. It just makes it even more of a mess in the UK basically, which is weak for the pound, because the pound really is trading on domestic fundamentals. So it's making it even worse for the pound. We had that S&P downgrade. That is right, Jeffrey. You are really looking out for the fundamental data on the UK. That is great. Good for you. But we've also got this GDP report on Thursday, which is a good point. I tell you what, it's probably, out of a lot of GDP reports, probably the most eagerly anticipated one that I can remember, probably for the last kind of couple of years. So it comes out 9:30 a.m. London time on Thursday. Basically, it's whether or not we get into a triple dip recession. It's a really important GDP report, even though it is quite historical data now, because we just haven't been in triple dip. I don't think ever, but I'm not gonna quite say that yet. But yes, we haven't. A triple dip recession is huge and has massive symbolic value, and is probably going to just dampen confidence even further. So the prospect, I think, that we're about 50-50 now of a triple dip. There's a chance that we may get kind of zero growth or 0.1%, so just about avoid it. But there is also a chance that we could equally get kind of minus 0.1, which would throw us into this triple dip. But overall, this 152 level is the key level to watch. Below there, from a technical perspective, the fundamental perspective, which Jeffrey has, he's all over it. There's a lot of reason for a weaker pound, even though we have weakened quite a bit. But I think those expectations that maybe a lot of the weakness was already priced in, maybe we're a bit premature on that. So, from a technical perspective, we're testing this 152 level now. I think, to be honest, we'll probably trade around that level, between kind of maybe 150, 150, 152. 30, if we do get below 152, that is, until we get that GDP report. And I think that, whatever happens, if we get that GDP report and it does suggest a triple dip, then we'll probably get, and it does show a triple dip, then we'll probably get a real knee-jerk reaction lower, potentially down to 150, even though we would expect 150 to hold. But again, if we manage to avoid the notorious triple dip, then expect quite a sharp relief rally, actually. If we were low 152, we think we'd shoot through 152, the 50-day moving average, potentially get back to this level here. So 153.50. I don't think we're going to see 154 again. If we get back above kind of 153.20, then we think we'll be rebuffed at kind of 154.20. So that double top, tweezed top there, that we saw just last week. So that's the pound. Now, the yen also has been a big mover. Now, I want to show you, we looked at it yesterday. Yesterday, it looked like we were going to really we were so close to that 100 level. Couldn't make it yet again. We got rebuffed there. But this is a really long-term chart that I'm showing you in dollar yen. This is the monthly chart. It goes all the way back to, it's a long-term chart, let me tell you. And this has the Ichimoku cloud. This just goes to show Jeffrey and Pan are saying, this is the Ichimoku chart, that's right. Jeffrey, this is our Forex Trader Pro, so Forex.com's trading platform. And as you can see, this is... why I'm just showing you this is that people were saying, well, what happens around about 100? What happens there? And I wrote something about that yesterday. It was on our website, gave you our strategy for that. Well, I'll speak you through it now. 100, obviously massive, very psychologically important level, of course. But we also have, where we could potentially go from there. 100 was always going to be significant. We've backed well away from there now. We're back below 98.70 today on the back of just kind of a stronger yen, really. The yen has strengthened, the dollar has weakened. It suggests that, 100 sounds about fair value, really. And that's there's been a lot of talk about how, 100 in dollar yen is really fair value. So that we may not have too much downside to go from there. But if we were to get above 100, which we think will happen, we think the market is probably looking for it. The market certainly does seem to be, to want to push it down there. Pullbacks have been very, very shallow, but if we get above 100, then 120, which is the top of this cloud, should act as very good resistance. So it just goes to show that the bar to getting over 100 in dollar yen is really, really high, not just from a fundamental perspective, but also from a technical perspective, because of this massive resistance level to the top of the monthly Ichimoku cloud. Jeffrey, wow, you should take over this job. High US yields we definitely need from the US, and we also need the Japanese people. We also need the Japanese investors to really start selling their yen, because they haven't actually done that, funnily enough. We've seen a lot of hedge funds sell the yen, but we haven't really seen domestic holders in Japan. Now, they started to do it, but they need to do it in a bigger way. But yes, the other chart I'm going to show you whenever you look at dollar yen is obviously, I don't know if you've ever joined these before, Jeffrey, but we often, one of the key charts that you need to look at when trading dollar yen is the spread between Japan and US Treasury yield. Now, there's been a little bit of a mess actually there. Just bear with me one moment while I pull it up. Just bear with me one moment, guys. I'm just pulling this up. Here we go. So this is what I was talking about just a little bit earlier. What it shows is the dollar yen, which is the white line on this chart, and also the spread between the US and Japanese 10-year bond yields. Now, this sometimes looks very complicated, quite sophisticated. It's really not. Yield analysis is important. Oftentimes, FX is one of the pillars of FX, one of the key drivers of FX is yield. So it's how much you yield, how much you earn on holding or selling or holding that currency, or having that, or trading that currency pair. What we've seen here is that traditionally, just even from looking at your eyes, dollar yen and the spread between US and Japanese bond yields tends to move together. What we've seen is that has massively even though US yields have fallen, Japanese yields have risen. Now, part of that reason was because at the long end, all across the curve actually have risen post-Japanese, post the Bank of Japan stimulus program, and that's because basically the Bank of Japan have come in and said, we're going to buy up, or we're going to be really greedy and buy up all of your Japanese government bond yields, and so people have been really willing to sell, and when you sell, then that pushes up the yield. So that's potentially the reason why. But right now, what we're seeing is actually that yield spread, without the yield spread being in support of a strong dollar, dollar gains are a bit capped there. So we may need to start to see Treasury yields actually start to outperform Japanese government bond yields to move higher. Now, there have been a few things. Gregorian has really been very patient regarding gold, and I'm going to go on to gold. So, Jeffrey, I'm going to leave the pound and the yen right there, but hopefully you've got some interesting nuggets. So this is the gold price, and obviously this is last week's carnage, and what we've seen this week is a nice recovery. However, we are running into key resistance at just around about 14.35. Now, let's take a look at that. What does this all mean? Ooh. That's not what I wanted. Just bear with me one moment, because there are some massive levels that you would need to watch out for. I think we're going to touch on there's some levels to watch out for. I'm just going to draw here so you can actually see them. Basically, this 1425 level, which is the 38.2% retracement of the decline from last Monday, is a massive resistance level. We couldn't actually get above there. There's a lot of people selling yes at this kind of 1450 level, as you can see here, 50% retracement of that move. There's a lot of sell orders, but we are actually running into a bit of interim resistance here now at 1425. So, I would say where we are now, we're at 1415. I don't know what your time frames are, Gregorian, but what you may want to do is actually move into... what you may want to do is actually think more about moving into potentially selling on any move back towards kind of the 1425 level. Because I think that looks like at the moment is gonna hold. Gold. What were the key drivers of pushing gold so much lower? There were a few things down so much last week. There's a load of fundamental stuff. It's too much to bear. Is it central banks? Is it ETFs? But basically, I think what from the fundamental perspective that I'm looking at right now, it feels like what we're seeing is the ETF market is gold actually starting to trade a bit like an equity. Now, we wrote this in our week ahead. You can find it on our website. But basically, gold trading like an equity, that is really significant because, there's a lot of there's been a big push in kind of a lot of like retail investors into gold. That makes it a little bit more volatile because basically when you get events like this, it basically breaks through a key support level, and all of a sudden the bottom falls out of gold and we drop $150 in a day. That suggests that maybe we're trading more like an equity and less like kind of steady, stable gold. Kind of another nail in the coffin for gold being the safe haven of choice. But where does that leave us now? Well, that leaves us now in investors. After big moves like this, we do tend to move sideways, but right now we're seeing a very traditional move that we see in other markets like FX. And also like in equities, you see, big sell-off, then the buyers come in, and then potentially at a key resistance level like a 38.2% fib retracement, then we see more selling coming in. So what it suggests to me, the fact that we have sold at this 38.2 level, we haven't really been able to, we'd had been as high as 1435 yesterday, but we didn't close at that level. We dipped back below this key level, suggests to me that, we could be... it suggests to me that we're not going to move higher anymore. Now, Nyasha makes a really good point. Too much volatility in gold for me. I know the point. I know the feeling. That gold volatility actually spiked above VIX volatility. That's how volatile gold was last week. It's fallen back now, but there is obviously, once bitten, twice shy, right, for some of those investors. So that's where kind of gold is. Now, what about the rest of the commodity space? Now, just bear with me one moment. I should have done this earlier, so I do apologise for this. I just need to do one quick thing, which is just show my disclaimer. I do apologise for this being... Oh, I don't know what's going on here. Hang on, I'll do that later. But basically, what we've... let's take a quick look at what the rest of the space is doing. The commodity space, let's take a quick look at copper. As you can see, this is copper. Copper has taken a real nosedive. Now, copper is very significant. It's a big industrial metal, but it also suggests that Stuart has just mentioned the 200-week moving average at 1437. Really interesting that you mentioned that, Stuart, because that's actually where we sold off yesterday. So that is really, that's massive resistance now. But this is copper, and I'm bringing up copper because it's considered quite an industrial metal. An industrial metal. It sold off very sharply today on the back of some weaker Chinese CPI data, but it is significant, I think, because it's going to make it very tough for equities to rally, etc., with commodity being so weak, and also Brent crude oil, which I'm going to show you now. As you can see, Brent crude oil had gone above 100 yesterday. It has fallen since. And I'm just lastly going to show you the S&P 500 as well, just as a kind of a benchmark global index. Good. Now, what we've seen, obviously, is that, stocks, they make these amazing comebacks. We're holding that 50-day moving average, and they actually followed European stocks higher yesterday, even though commodities tended to sell off. Now, commodities do tend to move before stocks, but for us, the fact that copper is so weak is a real lead indicator to us that stocks are going to fall. Now, that's not the only lead indicator. The other, of course, is the Dow Transport. For those of you who look at a Dow theory and maybe and also maybe read the Intermarket Analysis book by John Murphy, he talks about this, and that basically, this is the kind of the lead indicator. Transports, again, it's moved higher, but interesting enough, it's really off its actual highs. It peaked in March 15th. If we don't get above this 50-day moving average at 665-ish, we're currently closed 650, 665 is the level to watch, then it's going to be very hard for this to move. Now, I'm not necessarily saying that you may not be able to have access to Dow Transports. Okay, that's fine. You can find charts on this, and it's worth just keeping an eye on it, because if we fail at this big level here, we may not be able to move higher in the S&P 500 when the markets open in the US later on today. So that's the key level to watch. So I've done a lot of talking. My voice hurt. I'm going to pass it over to you. If you've got one question, I'm happy to take it. Very happy to take it. If you've got a question that you'd like me to answer. What's happening with Aussie? This is from Pan. Okay, great. That's the last question. Someone's just said, Jeffrey also said, would this be a good level to go long dollar yen? Well, put it this way, we still think that the bias is higher in dollar yen. So on any pullbacks, then yes. Why does weakness in China move commodities down? That's because China is such a huge user of commodities, Gregorian, so that's mainly the reason why. Let's take a look here at the Aussie, and as you can see, it's declined again. The Aussie has weakened. The Aussie has weakened, quite sharply. It was kind of around about 103.50 earlier, towards the end of last week. That's the 50-day moving average. It's now below its major moving averages, and is edging closer again to that 102 level. Remember, that's kind of a massive support zone. Likewise, we also have. Likewise, below there is 101.50 comes into view. So we're certainly at the bottom end of this range. We've had quite sharp moves lower. What was interesting is that when gold fell, the S&P obviously fell as well last week, and the S&P had its worst week since June 2012 last week. Now, the Aussie actually reformed its relationship with the S&P. Now, it didn't move higher yesterday either, so it just shows you there's maybe more downside to come in the Aussie. Now, one thing that I would say that could potentially protect us on the downside, so maybe could keep us, or have, if we fell to 102, maybe even 101.50, that could hold us good support until we get the next RBA meeting, which takes place next week. So as you can see, in terms of, I'm assuming what you're looking at, let's just get the 6-month chart here. You're looking at kind of a downward channel. Let me bring up my other chart. Just bear with me one moment. In the Aussie. With the Aussie, actually, I think what's been kind of more important are these key levels. So the 102 added to that 101.50 as well. So in terms of like downward channel, I assume that you're looking at your. I'm assuming, right, that you're looking at your. This isn't perfect. I'm assuming that you're looking at the hourly chart, so the shorter term chart, that's probably the better one to look at. But yes, the fact that we can't now, if we can't break above kind of 102.50, then it does open the way all the way down below sub 102, which is also the kind of long-term support level, or a key support level. Basically, Pan, they're kind of both saying the same thing. We are near a really key support zone. It's 102 and then 101.50, and you can actually look at it even from a horizontal level. There we go. As you can see here, massive level. It's held 1, 2, 3 times, going back to July last year. Well, Jeffrey, yet again, another nice comment there about politicians. Of course, I mean, well, actually, Jeffrey, for a long time, we've heard the politicians say that they're going to push down the Aussie, and they haven't done so well at doing that. Likewise, the RBA, they've been fairly neutral because yes, a stronger Aussie does impact the Australian economic conditions, and there is an election coming up in September. But one thing that was quite interesting, I thought Julia Gillard last week did manage expectations by actually saying that the Aussie, strong Aussie is here to stay. So we're not going to go, how far we go? Are we going to go back to kind of the 70s? No. We may go to 101.50 though, and that to us will, if we get to kind of 102 in the next day or two, I'm a little like, if you see here a series of lower bottoms, quite significant, but let's go back to kind of Pan, major support level, as you can see there, so hopefully that support. So everybody, thank you so much for your questions. You were great. You were really interactive today. Thanks for joining. Please do join us next time. There have been a few new people joining today. Do join again. It's great to have lots of views. Jeffrey, you've been great with a lot of your views, and they've been really, your insights are great and really worth sharing to everybody. So thank you all for joining, and please do join us next time for more. Thank you.